So what if I told you that the median price of a single-family home in Mammoth Lakes actually doubled in a single year?
I mean, that sounds completely impossible.
Right, jumping from 1.3 million to nearly 2.8 million dollars.
Hmm.
And yet, the data we're looking at today says this is actually a balanced market.
Which is just a wild concept to wrap your head around.
It really is. So welcome to the deep dive, everyone. Today we are looking at the newly released Mammoth Lakes real estate market update for the first quarter of 2026.
Yeah, since it's early April, we finally have, 3 full months of data to actually dig into.
Exactly. And the overriding theme of this entire report, the real mission for us today, is to unpack a market defined by three words: balance, selectivity, and resilience.
Which is honestly a profound shift in market psychology.
Oh, absolutely.
Because, we spent the last few years looking at a landscape that was just defined by sheer momentum. Buyers were waiving inspections, throwing cash at properties sight unseen.
Total panic buying.
Total panic. But now that the fog of that frenzy has lifted, we can actually examine the underlying terrain. And the mechanics of how people buy property in a mountain town they've fundamentally changed.
Yeah, and the best way I can visualize the mechanics of this shift is to think about how a skier navigates the mountain.
Okay, I like where this is going.
So during the boom, right, the market was like a skier on a really steep, icy downhill racecourse. In that scenario, you aren't really in control of your trajectory.
You're just trying not to crash.
Exactly. You are driven by gravity, by panic, and the desperate need to just, hold an edge and survive the descent. But this quarter's data suggests that the skier has transitioned onto a freshly groomed run.
Right.
The speed might still be there, sure, but now they are executing a smooth, deliberate, and controlled carve.
That distinction right there between panic and control, that is everything. A controlled carve requires actual intention. The skier has to actively shift their weight, read the snow, all of that.
Right, they have to pay attention.
Exactly. So what some people might look at right now and mistakenly call a slowing market is actually a maturing market.
Ah, maturing. That makes a lot of sense.
Yeah, the demand in Mammoth isn't driven by speculative panic anymore. It's not FOMO. It's driven by long-term lifestyle value. Sellers aren't over-leveraged and desperate to offload, and buyers are, they're finally taking a breath to evaluate the physical property before they commit.
They're actually inspecting the edges, so to speak. And to see what this controlled carve looks like mathematically, we really have to look at the two main property types, right? Condos and single-family homes.
Because the data shows these two segments are basically behaving like entirely different ecosystems right now.
Yeah, it's night and day. So let's start with condos, which the report highlights as the most active segment of the Mammoth market. And I have to say, the stats here are a bit of a brain teaser.
They really are. It takes a second to parse them.
Right, because overall transaction volume is slightly down. We're looking at about 17 sales a month so far in 2026, compared to 22 a month last year.
So fewer properties are changing hands overall.
Fewer transactions, yeah. But the median sale price is actually up. It hit $749,000 through March, which is higher than the $739,000 we saw in 2025.
Right.
But here is the twist that really caught my eye. While that overall median price went up, the median price per square foot actually dropped. It went from $675 down to $624.
Which seems completely counterintuitive.
Totally. And on top of that, the properties that do sell are moving faster. The days on market shrank from 74 days down to 64 days. So let me get this straight. Fewer sales, higher overall price, lower price per square foot, but moving faster. How does the math on that actually work?
I know it sounds completely contradictory until you really look at the underlying mechanism of buyer selectivity.
Okay, unpack that for me.
So that drop in price per square foot happening at the exact same time the overall median price rises, it points to a structural shift in what buyers are choosing to purchase. It suggests buyers are optimizing for overall value rather than, say, a premium location.
Oh, I see.
Yeah, so they might be opting for slightly larger units that offer more functional space. Or maybe units that are, slightly further away from the absolute premium core of the ski lodge.
So they're basically willing to take a 10-minute shuttle ride instead of a 2-minute walk if it means they get an extra bedroom for roughly the same total budget.
Exactly. You get more space, lower price per square foot, but the overall ticket price is a bit higher. And that drop in days on market reinforces this selectivity.
Right, because the good stuff is moving.
Exactly. The properties that are updated, well-presented, and priced appropriately for today's interest rates, they are moving swiftly. The market is very efficiently clearing out the good inventory.
But the report also notes that properties that feel dated, the ones still rocking the 1990s honey oak cabinets and original carpet, they're just sitting.
Yeah, they're languishing. The market is no longer rewarding mediocrity just because the property has a Mammoth Lakes zip code.
Which means the gap in value between a meticulously updated condo and a tired original condition condo is widening significantly.
Oh, massively.
Okay, so that's the condo side, a highly selective value-driven environment. But then I flipped to the single-family home data in this report, and I just have to push back hard on this whole balance
I
label.
had a feeling you would bring this up.
I mean, I have to. The median sale price for a single-family home in March skyrocketed to $2.84 million.
Yeah.
In 2025, that median was $1.3 million. If I am a buyer looking at a price tag that literally more than doubled in 12 months, I am thinking this market is broken, not balanced. What is the data hiding here?
It is hiding the most classic statistical illusion in real estate reporting.
Which is?
The sample size distortion. You always have to look at the volume. So for condos, we had about 17 sales a month to average out, right?
Yeah, 17 a month.
Well, for single-family homes, we are looking at approximately 4 sales per month. 4.
Wait, really? Just 4? So a sample size that small has absolutely no statistical armor. I mean, any single outlier completely wrecks the average.
You nailed it. Total inventory for single-family homes was just 21 active listings heading into April. When your transaction volume is sitting at 4 sales a month, just 1 or 2 ultra-luxury properties closing in March will violently skew the median price upward.
Wow, okay.
It doesn't mean a 3-bedroom house that was legitimately worth $1.3 million last year is suddenly worth $2.8 million today. The dirt itself didn't double in value.
Right, the houses didn't magically get twice as nice.
Exactly. It simply means the mix of what happened to cross the finish line in those specific 4 transactions trended really heavily toward the high-end luxury market.
Okay, that makes a lot more sense. It's a reflection of the specific homes that sold, not massive appreciation across the board.
Right. And if we look past that statistical noise, the underlying mechanics for single-family homes are actually identical to condos. The fundamentals are ruling the day.
Meaning buyers are still being picky?
Very. Aspirational pricing, where a seller just throws a massive number at the wall to see if someone bites, is being heavily punished by buyers. Across the board, regardless of property type, the report shows that properties are generally selling 3 to 5% below the initial list price.
See, that 3 to 5% metric is a vital anchor for you to keep in mind when evaluating a listing. It mathematically proves that buyers have clawed back some leverage at the negotiation table.
Definitely.
But having established that broad, town-wide statistics can be wildly misleading, we really need to zoom in even further. The report breaks down the inventory into very specific price bands, and the differences are just extreme.
They really are.
Looking at the overall inventory in Mammoth is kind of like looking at mountain microclimates. It can be sunny and perfectly calmed down at the Village Lodge, but an absolute blinding, wind-whipped blizzard up at the summit. You really have to know exactly what elevation you're standing at.
That's a great analogy, and the most fascinating weather anomaly in this report is actually sitting right in the middle of the condo market.
Yeah, let's look at that anomaly. If you are shopping for a condo priced between $1 million and $1.5 million, there is currently a staggering 21-month supply of inventory.
Almost 2 years.
Nearly 2 years' worth of condos just sitting there.
Mm-hmm.
But all the other condo tiers, the ones under 1 million and the ones over 1.5 million, are sitting at a very healthy 5-month supply. Why is that specific $1 to $1.5 million slice of the market completely stalled out?
It comes down to a financing no man's land.
Oh, interesting.
Yeah, you have to think about the buyer demographic for that specific price point. So a buyer looking at a $700,000 condo can often utilize standard financing with a reasonable down payment.
Right.
And on the other end of the spectrum, the buyer purchasing a $3 million luxury property is often paying all cash or utilizing specialized wealth management lending. They aren't really as sensitive to daily mortgage rate fluctuations.
The buyer in that $1 to $1.5 million range is basically caught in the middle.
Precisely. They are often stretching to reach that luxury tier, meaning they absolutely need a mortgage. But at that price point, they frequently exceed standard lending limits and get pushed into jumbo loan territory.
Which changes everything.
It changes everything. Jumbo loans have stricter underwriting, higher reserve requirements, and often require a much larger percentage down. When you combine those tighter lending standards with interest rates sitting in the mid-sixes, that specific buyer pool shrinks dramatically.
I can imagine.
Plus, a lot of the condos sitting in that $1 to $1.5 million band are older, larger units that require heavy renovations. A buyer facing a massive jumbo mortgage payment simply doesn't have the stomach or the leftover cash to then gut renovate a kitchen.
So if you are shopping in that specific $1 to $1.5 million tier right now, you are walking into an undeniable buyer's market.
Oh, absolutely
With the
right.
luxury of time, you have a mountain of options, and you have massive negotiating power. You hold all the cards because those sellers are really feeling the pressure of sitting on the market for months on end.
But, and this is a big but step outside that one specific microclimate, and the leverage flips. In the single-family home market, almost every single price tier under $2.5 million is in a tight seller's market.
So the blizzard is still raging over there.
Yes. The inventory is heavily constrained. If you are trying to buy a freestanding house under $2 million, you still need to move with absolute purpose. The sellers hold the leverage there, and hesitation will cost you the property.
Okay, so as a buyer, you might be able to negotiate a hefty discount on the sticker price of a condo, but we really need to talk about the brutal reality of what happens after the purchase.
Yes, the carrying costs.
Because whatever victory you win at the negotiating table can basically evaporate the moment you get the keys. This report shines a massive spotlight on the hidden costs of mountain living.
It really is the structural issue that is quietly reshaping the entire Mammoth real estate landscape.
The report explicitly states that mountain property insurance availability remains one of the most complicated hurdles for any transaction right now. The California wildfire insurance crisis is just squeezing mountain towns incredibly hard.
It's a huge problem. Major admitted insurance carriers have pulled out of high fire risk zones entirely.
Which leaves buyers doing what?
Well, buyers are being forced onto the FAIR plan, which is the state's insurer of last resort, or they have to go into the secondary non-admitted market, where premiums are astronomical and coverage limits are highly restrictive.
So you simply cannot wait until week 3 of a 30-day escrow to start shopping for an insurance policy.
No, you have to start day one. And that individual insurance crisis triggers an inevitable domino effect on the homeowners associations.
Right?
Increasing HOA dues and massive special assessments are no longer rare exceptions in Mammoth. They are the baseline reality.
Let's explain the mechanics of that for a second.
Yeah.
Because buying into a condo HOA is essentially like buying a used car where you share the engine block with 50 other people.
That is a hilarious but highly accurate way to look at it.
I mean, you aren't just buying the granite countertops and the private balcony. You are legally tethered to the maintenance liabilities of every single other unit in that complex.
Exactly. And HOAs operate on razor-thin margins. Their two biggest expenses are master insurance policies and exterior maintenance. Right now, both of those costs are exploding.
Because of the fire risk.
Right. When a master insurance premium for a 40-unit complex jumps from $50,000 a year to $250,000 a year, which is happening regularly across California, by the way, the HOA has no choice but to bridge that gap. They adjust the monthly dues upward just to keep the master policy active.
And when raising the monthly dues isn't enough to absorb the shock, they hit the owners with a special assessment.
The dreaded special assessment.
Right, which is a one-time mandatory bill that can easily run into the tens of thousands of dollars. And the report points out this isn't just about insurance, it's also about deferred exterior maintenance, catching up to older complexes.
We have to remember the physical realities of an alpine environment. Buildings at 8,000 feet take a severe beating. You have massive snow loads compressing the roofs.
Right.
You have aggressive freeze-thaw cycles where snow melts during the day, seeps behind the wood siding, and freezes solid at night. It's physically prying the building apart. After 30 or 40 years, patching the siding just doesn't work anymore. The entire exterior envelope needs to be replaced.
Which brings us to arguably the most critical piece of advice for anyone looking at property right now. If you are browsing listings online, are you scrutinizing the HOA financials as aggressively as the interior photos?
You absolutely have to.
Are you demanding to see the reserve study? And let's clarify what that is, just in case. The reserve study is essentially an audit of the HOA's savings account. It projects exactly when the roof, the siding, and the asphalt will fail and measures whether the HOA has enough cash sitting in the bank to pay for it.
Yeah.
If that reserve account is underfunded, you are buying a ticking financial time bomb.
The fundamental definition of affordability in mountain real estate has shifted. It is no longer just, can I afford the mortgage? The vital question is, can I afford the carry costs? Ignorance of an HOA's financial health in 2026 is a recipe for a complete disaster.
And building on that theme of affordability and carrying costs, we have to examine the biggest lever of them, all mortgage rates. Because the prevailing cost of money basically dictates the entire rhythm of this market. So, how are rates shaping the outlook for the rest of the year?
Well, the report provides a pretty clear snapshot. As of April 4th, 2026, the prevailing conforming rate for a 30-year fixed mortgage is sitting at roughly 6.45%, and jumbo mortgages are hovering around 6.6%.
Just to define those terms for clarity, a conforming loan is a mortgage that falls under the maximum dollar limits set by government-backed agencies like Fannie Mae and Freddie Mac. A jumbo loan exceeds those limits, meaning the bank assumes more risk, which is why the underwriting is so much stricter, like we discussed with that $1.5 million condo tier. So standard rates are sitting in the mid-sixes, and the report actually calls this stabilization a breath of fresh air.
I know. It sounds totally counterintuitive to call 6.5% a breath of fresh air when we all remember the days of 3% rates.
Those were the days.
But context dictates market psychology. We are coming off a brutal multi-year rate hike cycle that absolutely paralyzed buyers. The fact that rates stabilized at the end of 2025 and have held steady through the first quarter of 2026, that changes the game.
It removes the dread, I think.
Yeah.
When rates are violently fluctuating every single week, buyers are terrified that if they don't lock in a property today, their monthly payment will be $500 higher by next week.
Exactly. It forces people to make terrible panic decisions. But stabilization allows for strategy. When buyers know what the cost of capital is actually going to be, they can actually build a realistic budget. They can calculate exactly how an increased HOA fee or a hefty insurance premium fits into their monthly output.
Yeah, they can finally do the math.
So based on this stable cost of money, what is the actual projection for the Mammoth market through the rest of 2026?
Expect a disciplined market. The report projects that even if there is some modest easing in interest rates later this year, perhaps dipping closer to 6%, it is not going to trigger a rapid, chaotic acceleration in home prices.
So no returning to the madness.
Right. We aren't going back to the frenzy of 40 offers on a single house. Instead, any small declines in rates will simply support steady transaction volume. It will improve affordability slightly and allow a few more buyers to enter the market, but the overall environment will remain very measured.
So to survive and actually win in the Mammoth Lakes market in 2026, you can't rely on luck or timing. You really have to treat the process like an investigation.
You cannot rely on broad statistics, because a town-wide median price means absolutely nothing to your specific transaction. You need to identify the exact microclimate of your price band. You have to aggressively front-load your insurance research before you ever write an offer. And you must forensically examine the HOA's reserve study so you don't inherit someone else's deferred maintenance bill.
That perfectly summarizes the structural reality of the market right now. But there is one final, pretty provocative detail buried in the single-family home section of this report that I think points to a much larger societal shift in how we interact with mountain towns.
Oh, I'm definitely intrigued. What is the detail?
Well, the report specifically notes a rising trend among single-family home buyers. It states they are heavily prioritizing features like, quote, flexible use, including ADU potential.
Right. An ADU is an accessory dwelling unit. So think of a basement apartment with a separate entrance, a detached cabin in the backyard, or like an in-law suite over the garage. Okay, so buyers want the ability to rent out a portion of their property to generate income. I mean, that makes sense on the surface.
It does make sense. But think about the underlying mechanics we spent this entire time unpacking. We have an exploding baseline cost of ownership. We have master insurance premiums literally tripling. We have interest rates holding steady at 6.5% and a median home price hovering near $3 million.
Wow, yeah, when you put it all together like that.
It raises a massive question about the viability of owning a mountain home.
Are you suggesting that generating rental income is no longer just a clever way to offset costs, but an actual requirement?
That is exactly the question we have to ask. Are we approaching a mathematical tipping point where having an ADU transitions from being just a nice-to-have luxury like a little bonus space for guests into an absolute financial necessity just to carry the baseline costs of a single-family home?
That is wild. If the math reaches a point where the only way to afford a family retreat in the mountains is to simultaneously operate it as a multi-unit rental business, That completely alters the culture of these communities.
It changes everything.
You aren't just buying a getaway, you are buying a second job as a landlord just to pay the insurance premiums.
Yeah.
That is a heavy concept to evaluate if you were looking at stepping into the single-family market right now.
It really is.
But I guess it all comes back to our skier, analyzing the terrain ahead. The conditions have fundamentally changed. You can't ski this run the way you did 5 years ago. You have to adjust your stance, check your edges, and lean into that deliberate, controlled carve. Because if you understand the actual mechanics of the snow right in front of your skis, the mountain is still yours.